Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, June 16th, 2023. At the start of this week, we learned that inflation, as measured by the Consumer Price Index for all urban consumers, rose 0.1% in May and increased by 4% over the past 12 months, and that was the smallest annual increase in CPIU since March of 2021, for over 2 years, and that's meaningful. 2 days ago, Fed Chair Jerome Powell confirmed what almost everyone was expecting, which is a pause in the steady string of interest rate hikes that began over a year ago. I believe it was March of last year. However, he also said that future rate hikes are likely, and I think he mentioned probably 2 more this year, until inflation is brought fully under control. But that remains to be seen. My colleague, John Pearce, noted yesterday that Powell may be bluffing about future rate hikes as in an attempt to tamp down Wall Street's expectations. And by the way, if you don't already do this, I suggest you go to the Investing Daily website a couple times a week and read the articles posted by John and myself and some of our other analysts. There's a lot of good information there. And I think John is spot on in this article. Powell may be using the bully pulpit, so to speak, to just sort of top down expectations to keep the market from getting too frothy. Right now, the S&P 500 is at its highest level in over a year. I'm going to slide my head over here. So over here on the far right is where the S&P 500 is today, and you can see it around 2:15 this afternoon. It's at a little over 4,400. And if you look at this dotted line all the way across, you got to go all the way back to last April until the S&P 500 was higher than it's higher now. So it's reached a 12-month high, which is good news. And it's a welcome change from the pessimism that pervaded Wall Street only a few months ago. You may recall in March, after the collapse of Silicon Valley Bank, everything was going down and people were afraid the whole global banking system was on the verge of collapse and so on. And you can see that fear, by the way, right here, this little dip, that was the Silicon Valley banking collapse. But you can also see in the past month, and now I'm going to make this year to date so it's more pronounced, you can see that this upward curve has really gained momentum really over the last month. So a lot of optimism on Wall Street. And to be sure, that's good news and a welcome change from the pessimism. But as I stated last week, now would be a good time for everyone to take a breather and wait for more empirical data to come in before taking action. There is no compelling reason to disrupt the new equilibrium that's been established among the stock, bond, and commodity markets. And that new equilibrium, we can define it now. I mean, it's visible in the market. It can, if we look at oil prices, and again, I'm going to look at the chart here. You look year to date, and right down here, you can see it's starting to trade in a range here between $70 and $80 a barrel, and really more like between 70 and 75. So that's part of the new equilibrium. And then if you look at the price of gold, it's also, if you look at the price of gold, it's also settled into an equilibrium price of around $2,000 an ounce. And again, look here, this is since March, and it's just hovering in a very narrow range around $2,000 an ounce. And then the third major component is the yield on the 10-year Treasury note, which is also settled in at around 3.75% or so. And again, here is also this range, and today it's 3.77. So those are the big three, and they're all now been trading very consistently in those ranges. And as long as those values remain in place, we can expect to see the CBOE volatility index remain at its lowest level really since the onset of the coronavirus pandemic 3 years ago. If we look at the 5-year chart of the VIX and you look at here at low, you got to go all the way to this enormous spike really in February and March of 2020 when COVID-19 really blew up. And now the VIX, and the lower, by the way, the better in terms of fear. So those relationships are now set, and the financial markets like them. But if any of them change by a meaningful amount, that probably means that something else is about to undergo a major shift too. And that something else may be the stock market, but it could also be currency values or commodity prices. At the risk of sounding Pollyannish, it's possible that the soft landing for the economy that seemed impossible a year ago is now within our grasp. We may have one more quarter of subpar corporate earnings to endure, but the stock market is already looking ahead next year, and it likes what it sees. So what could go wrong? A resurgence of inflation, an escalation of the war in Ukraine, and who knows what might happen to the global financial markets if the U.S. dollar plunged in value. Those are the known unknowns that keep the stock market analysts like me up at night. But there are also the unknown unknowns, such as the pandemic, that we can't foresee. But right now, Wall Street seems to believe that none of those things is likely in the months to come. Thank you, and that's this week's video update, and I look forward to talking to you next week.